All right, welcome back to The Explainer. Today, we're diving into a company that is honestly a total paradox, SkyWest, ticker SKYW. This stock literally splits the opinions of some of the greatest investing minds right down the middle. We're talking flashing warning signs on the balance sheet, but at the same time, massive hidden upside that Wall Street just seems to be ignoring. So if you're the kind of person who loves untangling a complex financial puzzle, you are absolutely in the right place.
Here's our flight plan for today. We'll start with the SkyWest business model. Hit the 7 critical red flags, uncover 7 hidden green flags, run it through the guru frameworks, and then wrap up with our final verdict.
So let's kick things off with this staggering number, 600%. Yeah, that is the actual return SkyWest has delivered over the last 5 years since its pandemic lows. Today, it's sitting pretty with a market cap around $4.5 to $4.8 billion, trading in that $95 to $105 range. Look, a run-up like that, it demands our attention. But to figure out if it has the fuel to keep going, well, we got to look under the hood.
Section 1. The SkyWest business model. Why they aren't your typical airline.
You see, SkyWest is the largest regional airline holding company in the U.S., but here's the kicker. They aren't actually relying on you or me buying a ticket directly from them. Instead, a massive 84% of their revenue comes from contract flying. The remaining 16%? That comes from steady, high-margin aircraft leasing, which gives them some really fantastic diversification.
Now that 84% chunk is driven by something called Capacity Purchase Agreements, or CPAs. Basically, SkyWest partners up with the big guys. Think United, Delta, American, Alaska Airlines. These major carriers pay SkyWest a fixed fee just to operate their regional flights. And the crucial takeaway here is that the major airlines are the ones absorbing the fuel costs and the ticket pricing risks. This CPA model is literally SkyWest's secret weapon, effectively insulating them from the usual crazy swings in airline demand and fuel prices.
Moving on to Section 2, 7 critical red flags. Navigating the headwinds.
All right, so here's where things get bumpy. Operational pressure is definitely squeezing this company. First up, Goldman Sachs actually downgraded SkyWest to neutral in early July 2026, cutting their price target. Why? Because partner airlines are planning slower capacity growth, and SkyWest is heavily at the mercy of their partner schedules. Second, we're seeing some real margin compression. Their net profit margin dropped from 10.6% down to 9.8%. And remember how I said the CPA model protects them from most fuel costs? Well, it doesn't protect all of it. Their prorate flying segment, where SkyWest flies at their own risk without those fixed fees, took a massive hit. In Q2 2026, prorate fuel expenses surged a whopping 117% to $61 million.
And this operational squeeze, it feeds right into a highly leveraged balance sheet. Just look at this number, 10.88x. That is SkyWest's net debt to EBITDA ratio. To put that into perspective, a healthy conservative threshold is usually anything under 2x. So sitting at nearly 11 times, yeah, that is a glaring, massive red flag when it comes to their overall leverage.
Unfortunately, the financial warning signs don't stop there. Looking at liquidity, their current ratio sits at a highly concerning 0.62. Now, you usually want to see that above 1.5, so this means they could legitimately struggle to cover short-term liabilities. Add to this an Altman Z-score of 1.71, which, if you're not familiar, is a metric used to predict bankruptcy, and that puts them firmly in the financial distress risk zone. And the cherry on top, insiders are cashing out. Over a recent 6-month stretch, insiders, including the chief commercial officer, sold nearly $3 million in shares. When executives are selling while liquidity looks that tight, you really have to pay attention.
But hold on, let's flip the script. Section 3, 7 hidden green flags. Catching the tailwinds.
Okay, despite all that turbulence, SkyWest actually looks wildly undervalued through traditional valuation lenses. Seriously, Benjamin Graham's conservative formula gives us a Graham number of $126.99. That means the stock is trading at roughly a 34% discount. And if we use the Peter Lynch fair value, it spits out a staggering $260.75. There's real upside here. On top of that, Guru Focus gives them a super strong quality score of 85 to 87 out of 100 and a solid 6 out of 10 for their economic moat. That moat, by the way, is driven by incredibly high switching costs. I mean, transitioning hundreds of daily flights, pilots, and aircraft to another operator, that takes years. It's a genuine, durable competitive advantage. And that deep competitive moat is translating directly into operational strength. In Q2 2026, SkyWest posted a huge revenue beat of $1.1 billion. That's a 9% sequential growth.
They even achieved an almost unbelievable 99.9% adjusted completion rate on nearly 228,000 flights. Management is projecting 5% block hour growth for the year and guiding to a full-year EPS of roughly $11. Plus, and this is big, they're aggressively returning value to shareholders. They've actually already retired over 15% of their total shares.
Just let that sink in for a second. $75 million in share buybacks in Q 2026 alone. Despite those liquidity concerns we were just talking about, management is confident enough in their cash flow to buy back 833,000 shares in a single quarter. And get this, since 2020, they've actually reduced their debt by $1 billion. So management isn't just sitting around. They're actively attacking that heavy balance sheet while still heavily rewarding their shareholders.
Section 4. The Guru Frameworks. Putting it to the ultimate test. Okay, let's dive into this scorecard. We ran SkyWest through the investment frameworks of Peter Lynch, Benjamin Graham, and Warren Buffett to see what happens. For Lynch, it is a strong fit. He loves growth at a reasonable price, or GARP, and SkyWest has a PEG ratio of exactly 1.0 alongside a 25% 5-year EBITDA growth rate. It is a textbook Lynch play. But for Graham and Buffett, the signals are a lot more mixed. While Graham would love that low PE of 9.8, that 0.62 current liquidity ratio we mentioned, that is an absolute deal-breaker for his defensive style. And Buffett, well, he probably likes the 15.6% return on equity, but their return on invested capital is only 9.5%, which falls short of his 15% target. Plus, let's be real, Buffett historically really dislikes the low-margin nature of the airline industry.
And guys, this right here reveals the central paradox of this entire explainer. We've got two investing legends looking at the exact same data and coming to totally opposite conclusions. The Peter Lynch view screams buy based on these incredible growth metrics and massive fair value upside. Meanwhile, the Benjamin Graham view screams caution. His deep value perspective simply cannot look past that immediate liquidity crunch.
Section 5. The Final Verdict. Deciding your flight path.
It all comes down to the million-dollar question. Can SkyWest actually maintain the earning stability of its CPA contracts, hit that 5% block hour growth target, and ultimately deliver on that $11 EPS catalyst? Or is the high leverage, the scary 0.62 current ratio, and the partner capacity slowdown going to drag them down? Because look, if they hit that $11 EPS guidance, this stock could see some serious upside. But if the balance sheet cracks first, well, that's a completely different story.
Which leaves us with one final thought to close out this explainer. At the end of the day, the deciding factor isn't actually in the spreadsheet, it's in your personal philosophy. If you're a GARP bull looking for growth at a reasonable price, SkyWest is incredibly compelling. But if you're a deep value bear demanding rock-solid liquidity, it's a hard pass. So, take a look at your own strategy, weigh those red flags against the green ones, and ask yourself, which type of investor are you?